Hello, everybody, and welcome to this special webinar where we'll be talking about crude oil, a very popular and high-flying instrument at the moment. I'm delighted to have you with us, and if you have any questions, I'll do my best to answer them, or please call us and ask to speak to a senior account manager who'll be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. Now, we would like to present our new offer exclusive to those watching this webinar. A special code will appear on your screen during the webinar, and I will repeat this special code at the end that you can use to take advantage of our special offer. Be aware that this offer will expire in 24 hours and that this new offer applies to all of you, not just second-time depositors. So please stick around. It will be well worth it. If you make a deposit within the next 24 hours, you can receive a balance bonus. If you deposit €1,000, you will receive a 2% balance bonus. Deposit 2,500 and you will receive a 4% balance bonus. Deposit 5,000 and you will receive a 5% balance bonus. Deposit from 5,001 to 15,000 and your overnight interest rate will be covered for 1 month. Deposit 15,001 to 25,000 and your overnight interest rate will be covered for 2 months. Deposit more than 25,000 and your interest rate will be covered for 3 months. You are, of course, free to use this bonus however you choose, but you might find it beneficial to use it on one of our market opportunities if you want to. Speaking of which, if you didn't know, a market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple-to-understand opportunity to trade in the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. Here is an example of a market opportunity. You can see fundamental analysis on what's going on with the pound-dollar currency pair. Below, you can see some geopolitical events that can influence the currency pair. It's important to look at the pivot point on which the calculations are based, that you can see at the center left of the screen. If the price reaches the level that you can see, this shows the right moment in our estimation to come in and open a trading position. You can see that this is a weekly market opportunity, although we have regular daily trading opportunities. You can also see the trend direction here, which is up. It's important that you know how to use the stop loss and take profit options. You have support and resistance levels encircled at the bottom left-hand side of the screen. At these points, you can put a stop loss and take profit. And at the top right-hand side of the screen, you have calculations. If you close the position using take profit, you can expect these kinds of profits. If the price is going against you, you can potentially have a loss of the amount shown by support 1, 2, and 3. The pivot point is the starting price for opening a trading position. The support and resistance levels are here for daily, weekly, or monthly terms. Finally, profit and loss calculations are based on a one-lot trading volume. So, let's talk about crude, also known as liquid gold. But in some ways, it's more important than gold, since crude powers the world's economy, as well as being a commodity to trade in the markets. Unlike gold, crude is not a safe haven asset that tends to be affected by only a few factors. Crude prices can be affected by multiple factors. So let's break these factors down for you and explain the current situation. The most important considerations can be broadly broken down into two categories: supply and demand, and geopolitical factors. Supply and demand are crucial factors that determine the price of oil. A greater supply of oil or higher oil production tends to drive prices downwards. and vice versa, while a greater demand for oil tends to increase oil prices and vice versa. The Organization of Petroleum Producing Countries, or OPEC, was founded with the idea of providing a measure of control over the supply of oil, thus potentially reducing volatility in oil prices. The organization includes many of the biggest oil producers, including Saudi Arabia and most Middle Eastern oil-producing countries. Russia, Egypt, and a number of other countries also coordinate activities with OPEC as observers to make the organization more effective. We'll take a look at how supply and demand affects oil prices in a moment. Geopolitical factors are huge price drivers for crude. If we take a look at oil prices over the past 10 years, we can see that numerous oil price shocks were caused by geopolitical crises or wars in countries that produce oil. In August 1990, for example, after the Iraqi invasion of Kuwait, there was an oil price shock, which saw oil prices rise from $17 a barrel in July to $36 a barrel in October. These seem like small numbers in current conditions, but at the time, that was a doubling of the crude price. Most of the time, such geopolitical conflicts increase oil prices, but there are exceptions. On this graph, we can see how various events impacted crude over the years. I will return to geopolitical factors where I cover the current situation, but let's talk about supply and demand. OPEC and some non-OPEC producers led by Russia agreed to extend supply curves. The production cuts were introduced at the start of 2017 in a bid to revive prices. Leading players such as Saudi Arabia and Russia have pledged to do whatever it takes to stabilize the market and the oil revenues their economies depend on. But those efforts have been blunted by a massive boom in production by US shale operators who have become much more efficient. After nearly 16 months of output curves by OPEC and its partners has seen crude rally to a 3-year high near $70 per barrel. That's replenishing their coffers after the worst oil slump in a generation, encouraging producers to extend their intervention, even as Venezuela's petro economy, for example, implodes, and Donald Trump threatens Iran with sanctions. Analysts suggest that price gains could backfire on OPEC by spurring rival US supplies or crimping demand. But OPEC country ministers gathering in Jeddah on April the 20th last week focused on ways of prolonging their cooperation. That could include new inventory targets that extend the cuts and laying the foundations for an alliance that will last for years. Recommendations would have to be ratified at the group's full meeting in June. For decades, OPEC and Russia have been competitors in the oil market, but forged an alliance in late 2016 to combat the surplus unleashed by a boom in American shale. Though it's taken longer than expected, the strategy is paying off. With inventory subsiding to normal levels, the International Energy Agency says OPEC and its partners can declare mission accomplished, for the time being at least. According to the International Energy Agency, global daily demand for oil will grow by 1.5 million barrels per day. Demand is linked to economic growth and tends to go up when global economic growth increases, and vice versa. We can see increasing demand on the graph here since 2012. In recent years, we have seen an increased supply of oil, which helped to push oil prices down, causing OPEC to create oil production limitation agreements among its members to prop oil prices up. Russia is now the world's top producer of crude oil. It became important that any production cuts include the country, and in 2016, a deal was reached between OPEC and non-OPEC to cut production by 1 million barrels per day. The quotas were extended to 1.2 million barrels per day in May 2017, until March 2018. However, in December 2017, Russia and OPEC extended the production cut of 1.8 million barrels per day until the end of this year. The deal has been successful, with countries honoring it with a high degree of compliance. The group's output reduction is now 60% greater than the planned cut of 1.2 million barrels per day, as Venezuela's deepening recession hit its oil infrastructure. Meanwhile, President Trump has vowed to abandon an agreement with Iran on the country's nuclear activity and potentially reimpose sanctions on the nation's oil trade. If the Latin American country continues to deteriorate and Trump delivers on his Iranian threats, OPEC's unplanned losses could effectively double the impact of its intended production cut. US production has been rising for many months. This year, the US has overtaken Saudi Arabia as the world's second biggest oil producer, only behind Russia. As you can see, the US currently produces 10.2 million barrels per day, according to the American Petroleum Institute figures released in February. The Energy Information Administration estimates that US crude production will average 10.7 million barrels per day in 2018. Much of the increase in US production is powered by an increase in shale. On this graph, you can actually see how OPEC, Russia, and US production currently compares. Two organizations that supply regular figures on crude are the American Petroleum Institute and the Energy Information Administration. They provide weekly information releases on crude inventories, with the EIA publishing its crude oil inventories figures on Wednesday, and the IEA releasing its weekly crude oil stock on Tuesday. Both releases move the markets, but most analysts consider that EIA figures are more authoritative. Another important but less well-known data release that traders use is the Oil Market Report, which is issued by the International Energy Agency. The report, published every month, provides issues affecting oil markets and a detailed analysis of oil market trends, which helps investors detect potential crude oil price direction. Oil prices are currently trading at more than 3-year highs, at more than $68. But why is this the case when, as we've established, US production is powering ahead? Well, as I've mentioned, geopolitical factors have played a huge role in supporting crude prices. Most recently, there was US-led military intervention upon Syria. While Syria isn't a major oil producer, the US is taking a more active role in the Middle East, raises the prospect of supply disruptions in the region. There is also the situation in Iran. The US is still considering imposing fresh sanctions upon the country. Another oil-producing country I've already mentioned, Venezuela, is experiencing political turmoil, which has supported crude. The OPEC and non-OPEC supply limitation deal is another major factor which has helped drive oil prices higher. Saudi Arabia is said to seek a price increase to $80 per barrel, according to analysts, to cover weighty domestic spending needs and attract investors to a partial sale of its state oil company, Saudi Aramco. Although Russia, less dependent on oil revenues, usually sounds more cautious about pushing on, Energy Minister Alexander Novak said he supports prolonging cooperation. Russian oil companies such as Lukoil have softened initial objections to the limitation deal with OPEC, which slows their expansion plans as the financial rewards become clear. The accord also serves political objectives for Russia, cementing President Vladimir Putin's role as a power broker in the Middle East, where his government maintains ties with the antagonistic regimes of Saudi Arabia and Iran and supports Syria's President Bashar al-Assad against a rebellion backed by Western powers. It can be quite complicated, but all of these complications tend to support crude oil prices. Regardless of the benefits, continuation to restrain output may be an odd policy for OPEC when accidental supply losses inside the cartel are mounting and other threats of disruption loom. Well, in case you missed the promo code during the presentation, this is your opportunity to take advantage of our special offer, which will last for 24 hours. The promo code is FTD1X. And of course, at 4Trade, we'll be following any developments that affect the markets very closely. So please do get in touch with the senior account manager if you have any questions or want to take advantage of the trading opportunities. Goodbye, and please join us at 4Trade again soon.